Hello everyone, live from Chicago. It's Thursday, August 10th, 2023. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are so glad you're with us tonight, and a special welcome to those of you joining us that may have never seen the program. We are glad you're here and hope you find the time worthwhile. No doldrums. We may be in the summer doldrums, but we're not seeing it this year. And AI frenzies. What's that all about? Our 12 segments that we cover every month in this order usually, but sometimes I mix it up. Try to give you a variety of things, what's going on in the market, what has happened, what I think may happen, how we're going to react if it does happen. For those of you that are new to the program, please subscribe to us on YouTube. Click the little bell and you'll be notified whenever we go live. That's usually every second Thursday, although next month will be an exception, and there are times that I just go live out of nowhere and surprise you because things are happening that I need to tell you about it. Also, follow us on Twitter, on Facebook, on LinkedIn. I tweet every single day. I guess I should say I X every single day. I don't know if we can use the verb tweet anymore. Sometimes twice a day, sometimes intraday, as I did this past month when the credit quality of the U.S. was downgraded. And I'll talk about that more tonight. Our next program, Thursday, September 21st, that is the third Thursday of the month because we need an extra week to prepare. Why? Because the chats are back. Those of you that have been with us since 2008, remember that when the markets were imploding, I started a series of financial fireside chats around the greater Chicagoland area. Well attended, had a great time. We continued those until 2020 when COVID shut us down. We are now back live Thursday, September 21st. We'd love for you to be here. You don't have to live in Chicago. There are plenty of hotels in the Batavia area, and we would welcome you here, okay? The monthly review, the doldrums. What is a doldrum? A state of period or inactivity, stagnation, or depression. So I should say right away that if you're feeling depression, you need to hang up and call 911. Or you can stay till the end of the program, and I hope that you're no longer feeling depressed because there's a lot of good news in this program as there is every month. But this is not good news. All right. One of my readers said, we appreciate your intraday tweet here when we found out about the Fitch downgrade. So Fitch Ratings is one of three ratings companies. Moody's and S&P are the other two. There are others, but those are certainly the three major ones. So here is what Fitch had to say. The rating downgrade of the United States reflects the expected fiscal deterioration over the next 3 years, a high and growing general government debt burden, and the erosion of governance relative to AA and AAA rated peers over the last 2 decades. Now that's wordy, but basically this is because the U.S. has manifested itself in repeated debt limit standoffs, remember those, and last-minute resolutions, basically childish behavior in Congress. Further, they went on to chide and said, over the next decade, higher interest rates and the rising debt stock will increase the interest service burden. While an aging population, that's a U.S. population, and rising healthcare costs will raise spending on the elderly absent significant fiscal policy reforms. That is a beatdown from one of the three credit rating agencies. Now, the market did sell off. It came back the next day. It's been a very volatile week. The market's still trying to adjust to this. The last time we had a beatdown from a ratings agency was when S&P downgraded the U.S. from AAA to AA plus in 2011. That was actually much more dramatic than this has been, but we don't know the aftermath quite yet on this. We've just seen it for a week. So this is pretty important. The next thing is that Moody's, again, one of the three, decided to place the debt of 6 major banks, including State Street and the Bank of New York, under review for a downgrade. They didn't downgrade them, but they're under review. Now, this is puzzling to me because it comes 5 months after those California lenders collapsed. If you remember, Silicon Valley Bank, Signature Bank were brought down by depositors leaving for higher interest rates elsewhere in the declining value of government bond assets they were holding. So when a credit quality crisis like this starts, it's not generally tied to the stock market. It's tied to the bond market. It's tied to credit worthiness. And that is a source of concern. It doesn't mean that you have to batten down the hatches and pull out of the stock market. That's certainly not the case, as we are still within 6.5% of the lifetime highs, which were set on January 3rd, 2022. But it does mean that we are in the summer doldrums. August and September are typically the worst 2 sequential months performing-wise, so we have to be careful. We're watching it. That's what you pay us to do. That's what we are doing. So of the 10 stocks in the NASDAQ 100 The Magnificent Seven, and if you haven't heard this phrase, just picture the music in the background, okay? The Magnificent Seven theme song, plus 3 in this case, contributed 30% of the 36% in gains through the end of August, end of July. So we still have 10 days in August, and I haven't calculated it since then. But if you wonder what the Magnificent Seven are, they are NVIDIA, Apple, Microsoft, Meta, Amazon, Tesla, Google, and then we're adding in AVGO, which is Broadcom, AMD, and then Adobe. Okay, all the other stocks contributed 6.4%. Okay, so what that means is this is the top heaviness of the NASDAQ that has been pulling the market along somewhat begrudgingly. And what we are waiting for, this is going to be a year to determine, as you look back on a year, you don't know what it's going to look like going in, but as you look back on a year, so in December, January, we're going to know, were the rest of the sectors able to take the cue of the Magnificent Seven and start performing strongly themselves without just coattailing those leaders? That's what's going to determine how strong this bull market is. Now, we do have a stock here, General Electric. We have this in CG. We also have it in SpecOp, for those of you that trade that. Up 108% this year. So it doesn't have to be a Magnificent Seven stock to do well. This has to do with our screening, and I'll tell you more about that and how we use AI and screen stocks, etc. But this has been a real nice performer for us. But the 10 to remember in September, so I don't want to downplay this time of year, the worst Septembers to remember since 1928. Many of these are quite some time ago, but you can see that 2008, 2001, 2002, those were all pretty bad years. All right. But that doesn't mean that this year has to be that way. We're always watching what's happening currently in the market. And actually this month, until that downgrade, was pretty good. All right. We'll see how the market reacts going forward. The CPI report came out today. We'll get to that in the inflation section. Didn't really move the market too much. It actually shot up higher, but then gave a lot of it back by the end of the day. Now in the overseas market, as I can see it on my screen over here, Japan's pretty much ignoring it. We trade in Tokyo and Shanghai, and that's one of the reasons we are able to keep up on the international markets, because we actually have skin in the game over there. Okay, so you guys have seen this report. I always show you this every month. 422 of the 500 stocks in the S&P 500 have reported earnings. 79% have beat their expectation, or what they predicted. Now you can say, well, they just predict low. Okay, maybe. But 73 is a number that we follow, and this is beating that. We're seeing, especially in the green highlights there, consumer discretionary, consumer staples, healthcare at 92%, technology 92%, and actually the leading sector of the year, consumer services, at 87%. Here's a slide I have not shown you. This is the actual real, so not relative. This is relative performance of the sector. So this is where they're predicted to come in earnings-wise based on the conference calls from the CEO and the other people that are on these calls and saying, here's where we think we're going to come in, and they're beating those. But if you look at the absolute returns, we're still seeing 3 straight quarters of reduced earnings. So a 5.2 decline in earnings this current quarter, the worst performance since 2020. But revenue is back on track to rise at 0.6% from a year ago. So it's a mixed signal, candidly. But again, in a summer month, in a summer doldrum, if you will, I'll take a mixed signal. In general, stocks are holding up amazingly well with a number of geopolitical events happening. That's our next segment, okay? All right, actually after employment. So employment, we do this on the second Thursday so that we can see what the employment scenario is that comes out on the first Friday. So non-farm payrolls, the survey was for 200,000 new jobs, only came in at 187, but that's still a positive number. You can see all the way back to 2020, we only have one negative quarter of growth, or one negative month, I should say, of growth. Even though we're not really on fire right now with new jobs, we're still looking pretty good. The unemployment rate continues to be at or near a lifetime low. Now, you've heard about a statistic being off the chart. Literally, you can see the lines break there because the unemployment rate spiked to 10.6% somewhere about the U in August up there because, again, it's off the chart. But the unemployment rate staying low is a very strong indicator that we are still a ways off from any inflation, not inflation, but a recession warning. I just don't think we're there yet. We've got a recession segment in this, as you know, but remember that slide when we come back to it. So as far as this U.S. employment level, here's why I like this so much. So the blue lines see together moving, and then in 2020, obviously that huge V-shape move downward. That's when the actual employment numbers crashed. But the CBO, which is the Congressional Budget Office prediction of what employment will be, continues along with the dotted line, and we've now exceeded that. So this was a downturn essentially about 2/3 as deep as the 2008-2009, even though it happened really, really fast. But it has now reached and exceeded the CBO predictions. The reason I'm excited about this is because of the recession calls. And it's just, you can't have a recession when jobs keep increasing. Even if they're not increasing at a phenomenal rate, you can see from the chart that it's still a very positive experience. Okay. Welcome from North Dakota, Fran and Hossein. Good to see you. Hey, Keith from Pal Joey's in Batavia. All right. Fantastic. So why is U.S. policy in our program? Because politics, even though it's a very uncomfortable topic, leads to policy, and policy has personal impact, and personal impact with policy leads to portfolio performance. How about those P's? That's why we cover it, because what happens in Washington at the state levels does affect how we invest. So this is something I just saw happen recently. Russian and Chinese naval forces near the coast of Alaska, the largest such flotilla to approach American shores. Word of the day, flotilla, a group of ships approaching a landmass. Okay, 11 Russian and Chinese ships. What are they doing there? I mean, really, are they going out there looking for crab cakes at one of those little restaurants on the Aleutian Islands? Come on, guys, what are you doing? This is nothing but provocative, all right? The ships, which never entered U.S. territorial waters, have since departed, but they were shadowed by 4 U.S. destroyers and numerous P-8 Poseidon aircraft. So the U.S. obviously took this very, very seriously. If you're concerned that whoever's running the White House and the government right now is not paying attention, I think that's exactly why this provocateur from the Chinese and the Russians happened. They just wanted to see if there was going to be a response. This is sort of an extension of that balloon that happened many months ago. So my take is, given the context of the war in Ukraine and tensions around Taiwan, this move is highly provocative. Again, does it mean that we're changing anything in the way we're investing? No. This is a future. Remember, the first segment that I do talks about what caused the market to do what it's done in the month since I've seen you. Going forward now, each segment is what I'm taking into consideration as I plan my investment strategies going forward for the next month and beyond. So in July, there appeared to be chaos in Moscow, and actually possible that Vladimir Putin would have been thrown out of office because he was humiliating Russia. There are 2 outcomes here that became unlikely. The first is that Russia would actually destroy the Ukrainian army and occupy Ukraine. That's not going to happen. Or that Ukraine's army would drive Russia out of Ukraine. And I don't think that's going to happen either. So the only logical step is a negotiated settlement. My take, on the surface, there's going to be a division of Ukraine. And I don't like that, but that's what I'm seeing. And it's 18 months into this confrontation now, and it needs to end to reduce the uncertainty. Another stat that I see from the U.S. Bureau of Economic Analysis is look back over previous administrations. Real net worth is dropping right now more than it has at any time in the last 23 years. Now, this is significant. Is it just clairvoyance or coincidental that it's happening during Joe Biden's administration? You have to decide, and you'll have to decide that at the ballot box. But if you look at this, you'll see it climbing during Bush, flattening, climbing at the end of Obama, really climbing strong during Trump's, and dropping during Biden. Again, you can make up your own mind whether this is just coincidental, whether these are policy changes at the federal level that are helping or hurting us. Certainly the inflation that has come back for the first time in 20 plus years has not helped growth these past 2 years. But that is a fact. And again, it's from a government agency, the U.S. Bureau of Economic Analysis. Now, you think things are bad here. Look at Europe. Okay, so Europe's current predicament has been a long time in the making. They have an aging population, as do we, with a preference for free time and job security over earnings. What that basically means is they are not particularly entrepreneurial over there, okay? Not known for an entrepreneurial spirit like we are in this country. And in fact, since the last show, there have been protests in the streets in Paris for the retirement age, mandatory retirement age, I think it's mandatory benefits extending to, instead of receiving them at 62, you receive them at 64. Okay, it's not 70 and 72, it's 62 and 64 and rioting in the streets because it's going to affect their comfy lifestyle, all right? So when you take that aging population, free time, job security, earnings, and all of that, and basically lackluster productivity growth, that's this 1-2 punch that is just killing Europe. Look at the US versus Germany, the UK, France, Italy, Spain. There's just not a good outcome here for Europe unless something changes in their mindset and unless they can get their GDP back on track. So the bottom line is this. In these geopolitical upheavals, Tina to the USA, Tina to the USA. And no, I don't mean Tina Turner. She's singing Rolling on the River somewhere, not here, but Tina, okay? There is no alternative. There is no alternative. With all of this geopolitical angst, we are still the place to be. We are still the place to be. All right. The Federal Reserve. John Connolly, thanks for signing in, buddy. China will broker a settlement re-Ukraine. That is a great thought. I appreciate you offering that. We're going to be following that. We follow this story every month, of course. Interesting to see that if China wants to step in, I wonder if they would bring a occupation of Taiwan into that settlement agreement. I'm winging this off the top of my head, but very interesting. Thanks, John, for sending that. All right, so the Fed, basically the Fed funds target rate back to where it was 2008. We know what happened after that, bringing it down during the last recession, the last huge recession. It dropped in 2020. It's gone straight up. But now, where are they going to go with it? Is it going to go down? Well, the Fed officials removed their guidance. That means their wording that had pointed to further increases. It's about time. All right? How much more can you squeeze this economy by continuing to raise rates? It's not healthy. It's not what business wants to see. So can Powell climb out of the Jackson Hole? For those of you who don't know, Jackson Hole, Wyoming, one of the most beautiful places in America, is where the Fed goes every August. They don't meet in August. Well, at least they don't have a Fed chair meeting with all the 12 governors there. They go out and party in Jackson Hole, Wyoming, and talk about aloof things and posit where things could go in the future. We'll see if the markets want to believe Jay Powell when he comes back. I think it's a mistake if you hear from him no more rate rises, but my opinion is they are done. Inflation, not so much on the burner this last month for a lot of other reasons because of the geopolitical items I just mentioned to you. But what I am noticing is that, so the bars you're seeing on the screen are how the S&P reacts when the consumer price index data is released. So this is one-day data. Look at this in August 2022, down more than 4% when the shock was so huge. So today it was not a real big shock. The market actually shot up and then sort of sold off the rest of the day. But it held its own, and we'll see where this plays out over the next 4 months or so. I think CPI is going to continue to dwindle, and in fact, the consumer price index, both the core, now remember the core is everything except for energy and food. Now, why you would want to take energy and food out, I don't know, but the Labor Department says, well, because those those entities are too volatile, except that, well, we really do need to know those. So there is still an overall CPI, and it too is on the drop. So those are two lines that are moving in the correct area. That's what we want. So I just want to give you a perspective here. China's consumer prices, look at the negative. Okay, what does that mean? You would think, well, that's good. It's going down. No, it's below zero. All right, that means deflation. Deflation is very hard for government officials to regulate. And in fact, they are in a deepening malaise. And here they are, the world's second largest economy, if you believe their data, in a potentially dangerous new phase. Well, my suggestion to the Chinese is take your ships, turn around, quit messing with us, and figure out what's going on in your own country, okay? But I digress. All right. Recession. This is pretty straightforward. I've given you enough data so far for you to know, but I am not concerned about it. All right, at least not right now. So the timeline for recession expectations continues to be pushed into the future. All right, so the start of the recession, is it going to be this quarter? No. Is it going to be the fourth quarter where there's a bunch of votes there and there are a bunch of votes that there's going to be no recession in the next 18 months? That's where I come in. And it's simply because of all the other data. Understand that a recession doesn't have its own data set. A recession happens when a bunch of other data points fail, all right? A bunch of other data points fail. That's how that works. So what happens when or if a recession hits? Unemployment rates will significantly rise during a recession. Reduced consumer spending. Consumers tend to spend less, of course, if they're concerned that, their jobs are going to go away, and reduce business investment because companies don't want to make more widgets if people aren't going to want to spend the money to buy them. I mean, that's what I mean by external data really causing a recession. A recession is a result of a bunch of other data points going sour. Right now, those data points are not sour. They're not even close to sour. And that is why I contend that if we have a recession, first of all, I don't know when it's going to be. And second of all, it's going to be mild. Just my opinion. We will trade it accordingly when we get there. But for right now, we are still 99% invested in both of our programs. All right. We simply are not to that point in the U.S. yet. The housing market. All right. And I want to just say I got a question here from one of our viewers, longtime viewers. And he had asked me this question last time, and I guess I didn't really phrase it too well. So before I start this, I'm just going to read this to you. So to clarify, I made a comment in your last show about home insurance companies leaving some states like Florida. And that is true. It is happening. In fact, I looked this up. It's a staggering number of American Capital Assurance, Avatar Property, Fed Nat Insurance Company, Florida Specialty, and actual Florida. If you specialize in insurance in Florida, you need to be staying in business. Okay, Guarantee Insurance Company, Gulfstream Property, Physicians United Plan, what's that? But some of these are pulling out. Some actually became insolvent because of the number of claims that were filed. But the viewer's question is, I was wondering if maybe the holding companies that now own large numbers of homes as rental properties. So sometimes people own rental properties for themselves, but other times, because it's a cash flow stream and corporations love cash flow streams, these holding companies come in and just scoop up a bunch of properties, put them on Verbo or whatever else and rent them out. But would they want to mitigate their risk and sell many of these homes as they become uninsured? I think that's a great question. Here's what I'm really wondering, though. Would they want to sell many of these homes before they become uninsured? So really, Florida is a mecca for a great portion of the country. People are leaving where they are and going to Florida. When I was growing up, Florida was the 17th most populous state in America. That shows how old I am. All right. But now it's the third most populous, behind Texas and California. That means Mormon, Illinois, Mormon, New York. I mean, big states, Massachusetts. All right. I think that you're going to see a situation where you're going to have these companies pulling out because they don't want to take the risk. I mean, the number of these insurance companies pulling out either because of default or because there are just too many hurricanes. I mean, the hurricane situation in Florida can do astounding damage in a 2-month period, usually September, October. more so than most any other state, with the exception of California and all their fires. So I hope that answers your question. I think that they're going to be pulling out before that. I think you're going to see that increase, but I also think you're going to see, assuming Governor DeSantis stays the governor of Florida, doesn't become president, you're going to see incentives for these entities, these holding companies, to come in and rent more properties, because it's good for the economy, and that's what they want down there. Great question. Thanks. I try to answer all questions, guys, when I can. So, all right. In real estate, we're seeing 17% year over year sales dropping here. Now, this is pretty strange. It doesn't surprise me. But in general, I think the number of listings is dropping because people just don't want to leave. They just simply don't want to leave. And what you're seeing is the time on the market is a little bit more than it was last July, but it's still, homes are selling faster than they did before the pandemic. So this is great for people that want to sell their homes, but they don't want to sell their homes. Why? Anybody tell me, Ryan, in the chat box? I think there's a 25-second delay, so I'm probably not going to give you time to answer. The answer is because 2.5, 3 years ago, you could get a home mortgage for even as low as 2.5. I had a 2 5/8. What am I trying to say? 2.625. I'm still converting to digits, from being a trader down at the Mercantile Exchange with, 5/8, 6/8, 7/8, whatever. So the point being, rates are way above that. I'm seeing 30-year at 3.2 right now. 3.2, 7.2%. And that makes it really tough to move and find a new home, all right? So they don't want to sell, so that's good for home builders. Now, I've had a couple people ask me, why do you have 3 home builders in CG? Well, first of all, we have 34 holdings, so that's only 10%. But we really like that sector right now. You have to build houses if people aren't going to sell theirs. And especially in locations in this part of the country where I used to live, in Nashville, that are just growing so fast, people aren't selling their homes. So the builders come in and they're just building as fast as they can. All right. Now, that financing often comes from the builders themselves. And that's why many of those homeowners are not having to pay 7.25. So all of this plays into, you're saying, why does this happen? Why do we care about this? Because the biggest item in discretionary spending to Americans is their home, and it matters how much people pay for a home. It matters how much they have to pay to keep it up, whether it's mortgage, insurance, etc., because what they have remaining is discretionary income. If they have higher discretionary income this year than last year, that's good for companies that make widgets, all right? And I want companies that are making and selling lots of widgets. That's why it matters to me as your portfolio manager, okay? So delinquency rates, you would think with interest rates rising that we would see people who are on ARMs, adjustable rate mortgages, foreclosing. Not happening, guys. We are back at the lows all the way back to 1998. All right, Freddie Mac, Fannie Mae, just not seeing foreclosures at all, and it's really positive. It's a healthy market in real estate, which we have to have. We have to have that. And so far, even though it's challenging to find a home, even though it's challenging to pay 7.25, I have an ARM on my property here. As you well know, I tell people I do not pay cash for homes. I did that once and I shouldn't have, because it was the beginning of a roaring bull market in 2013. And I quickly refinanced and took the money and put it in the market, which was smart. I'm not saying you have to do that. I'm just saying that if you're borrowing money, you want the lowest interest rate possible. And it will be coming down, and then those refis will be going crazy when that happens. All right. So economic indicators, when I get to this segment, I'm always talking about looking forward. So again, it's important you know that the first segment is how we got to where we got to, what made the market performance, and every segment after that is what I'm monitoring in various aspects of the economy to make decisions for the next month, the next quarter, the next 10 years, etc. Okay, that's why I have a new segment on the next 10. So economic indicators, a very positive sign for me here is that the highest average hourly earnings by industry, who's leading it? Leisure and hospitality. If we were doubting that they were coming back, We can see that they clearly have. People are returning to restaurants. They're returning to flights, which is the whole airline complication of trying to get to a place on time or are there at all because there are not enough pilots. All right. Hotels take months sometimes to get in and book. And it's because people were pent up for a long time and they want to get out. And that's why they're having to pay these workers more. Same with construction. Interesting with utilities, because there's so much more work from home, there's actually growth in a lot of utility companies. Now, I'm not going to say they're going to be a magnificent seven, but we do have utilities in our programs for this reason. All right, manufacturing, if you want to take a screenshot here, it's good if you want to study where are the earnings growing across the country. So consumer spending climbs again as Americans show confidence. So personal income increased less than expected, but again, this is important to know. Just because a person's income is not going up doesn't mean that they don't want to spend. They have an emotional decision to spend to buy stuff. Okay, I call this Americans desiring to live a deficit lifestyle. I'm not suggesting it or encouraging it. I'm just telling you like it is. All right. So the survey, 0.5% of growth, actual was 0.3, but people are still spending. Also, because of the Supreme Court ruling, growth in student loan balances continues to slow. That's because people are paying off their loans. They're starting to finally. And I think that there is, how can I say this carefully? Less and less people just going to college and saying, I'll just get a liberal arts degree and see how it plays out. And now I've got $120,000 in debt, and now I have to have a master's to do anything. I think it's going to cause more prudent consideration in how people are approaching a higher education, and that is a good thing. All right. Fewer firms see inflation as the most important problem. This is dropping the NFIB small business indicator. Is inflation the most important problem? It is not. So we want to see this chart going down. I try to clarify as much as I can. Some charts you want to go higher, like the stock market, okay? Some charts, like inflation and unemployment, you want to go lower. This is clearly a one where you want it to go lower. And again, this is not consumer sentiment. This is small business sentiment. Most of America is made up of small businesses. Yes, there are the magnificent $7 trillion companies, but small business is the backbone of the USA. And it's encouraging to see that they believe that inflation is not the single most problem. Less and less, when the peak there, it was 1 out of 3 businesses. Now it's 1 out of 5 businesses. So the only real object that I see of concern here is that we have a bunch of union strikes. And I'm not saying this is right or wrong. I'm just saying this is what's happening. We have the actors, UPS. Look at UPS. That's how many people they employ. It's interesting. I had a client where I used to trade UPS options because we were hedging. And this was really interesting. We would follow earnings releases and we would do all kinds of things. But UPS is a backbone of the U.S. economy. So if they go out on strike, talk about havoc. I guess you want to be long big shares of FedEx, but I can't really see how that's going to happen. Still, if the automakers go out, now I would say UPS going out is actually a bigger deal than the automakers because there are plenty of foreign automakers that can provide the vehicles we need. But at any rate, this is something that is definitely on my radar. So I said in my opening segment, AI craziness, all right? So I want you to know that AI is not going to conquer the world, all right? AI is going to change how we live. Nobody in 1993 could have predicted in 30 years where we'd be with the internet. It is inconceivable now that this planet would not have an internet. It's just inconceivable. I mean, it's right there with electricity and, frankly, the wheel from thousands of years ago, all right? Can AI be that big? I think it can be, but it's not something of which we want to be scared, all right? So let's look at, rather than some successes like I've done the last 3 segments, or the last 3 months, let's look at some failures. So with AI, hackers can simply talk computers into misbehaving. I like this little graphic here with the poison going into the circuit board. ChatGPT really has the ability to respond effectively and quickly, which is why there's 100 million users on it, all right? But they're also hackers. Now, are these hackers going to be able to get through? I guarantee you the companies like OpenAI that produces ChatGPT, and there's a bunch of others that do the same, they will be stepping up that security and making sure that someone cannot use a verbal instruction or a series of them or an automated, a machine-driven series of verbal executions to mess up the system. It's going to be real interesting to follow this, but I'm not concerned about it. Still, it does hamper the development. I'm looking at a comment here from Hussein. Credit card debt in the U.S. just exceeded $1 trillion. I saw that, Hussein. Thanks for bringing it up. We just spend. And I call it like I see it. I'm not saying that, we don't have a deficit lifestyle. I'm guessing that virtually everyone on this call, if you're one of my clients, you've heard about it from me if you live a deficit lifestyle. Because my job is to help you get to your retirement years with as little debt as possible. But we are a consumptive country, and that's one of the reasons why our GDP is so strong. It's also one of the reasons why our GDP, 67% of it, 2/3, a little more than 2/3, is driven by the consumer, and the other third is split between government spending and corporate spending. But you're correct, Hossein, $1 trillion in consumer debt. That is something to be concerned about, all right? So remember that guy who gave ChatGPT $100 to start a business? Well, it failed miserably because ChatGPT just wouldn't quit. It was determined that it was going to build a mega corporation on $100, all right? So again, there are limits to the intuitiveness of AI. Here's another area. So ChatGPT, is it getting dumber at math? There's a lot going on this graph, but look at the arrows that point to the left means it's getting dumber. So identifying prime numbers. Now, identifying happy numbers, that's a sequence of integers that are studied in numbers theory. That's going down. There are a few things that are going to the right, but basically when ChatGPT 3.5 upgraded to version 4, it went backwards, and they're not even sure why, okay? But it's actually become worse at performing certain math operations. I happen to think that GPT is better at intuitive analysis of thought patterns, speech recognition, speech correction. I think math is a little bit out of its realm right now, which is one of the reasons I'm not too concerned as a portfolio manager. But here's an interesting one. It seems the world's best artificial intelligence can pass tough exams. It can write convincingly human essays and chat so fluently that many people find their output indistinguishable from a live person. What can't they do? They can't solve simple visual logic puzzles like the one here. So guys, look at this. Look at the top section. So this basically says, here's what you have on the left. What needs to change for that to be on the right? All right, and you see how the pattern follows from the second row to the third row. So I'm sure you've seen this, but let me just give it away. Only similar shapes can continue forward. So dissimilar shapes have to stay behind. All right, we can see that with our eyes. We don't have to verbalize it. I mean, I'm instructing you, but you could see that without saying a word. It totally happens in your mind. But GPT and other AI programs at this point cannot do that. I think that will change over time. But right now, again, memory chips themselves don't think. When people get concerned that these computers are just going to take over the world and it's going to be a sci-fi thing crossed between Star Wars and the Jetsons, all artificial intelligence is a combination of thoughts, ideas, human interpretations stored in a gargantuan database with all kinds of access in multiple places at multiple times, and the ability for large learning models to calculate on that. So, okay, that's a lot. I get it. But we are still a ways from, it's still human input into this, all right? Until these robots can feed their own data in, and we are years from that. Remember when the Jetsons came out, everybody said 10 years from now, that's what everybody will be doing? No, didn't happen. Okay, so here's another IA quandary. If AI systems become appreciably better at driving cars than humans are, would it be unethical for people to drive on their own since this increases the risk of an accident? Well, what if AI was only somewhat better, but still saved thousands of lives each year? Should humans still drive, maybe with a stiffer driving test? These are challenging questions that have no solid answer. So about 75% of the potential value from applied generative AI will come in 4 business functions. These are the threatening areas, if you will: customer operations, marketing and sales, software engineering, research and development. And I would add on that, I believe, legal research. We at CB3 are carefully following this financial and socio-economic phenomena. Why are we doing that? 1, because it's fascinating. 2, because it affects us as humans and the people that we serve as clients, because they are friends of ours and their lives and their vocations matter to us. And 3, we want to be in the right place at the right time with the right opportunities. Obviously, if any of us could go back and rewind the clock 30 years, we would probably be different investors if we knew how this was going to play out from the beginnings of Netscape with dial-up modems in 1993 to the Magnificent Seven, trillion-dollar companies right now. We want to get on that bleeding edge, but we want to do so in an ethical and prudent way, and that's what we're going to do here. Millions may need to change occupations by 2030. Low-wage workers could well be hit the hardest, and they're going to have to retrain. I mean, you can't put the genie back in the bottle. Office support, customer support, production, food services, business and legal, I mentioned that earlier. So we're watching all this. Just know that this is one of the strongest areas for potential economic development, but also for societal disruption. Let me say that again. AI is one of the strongest areas in commerce for business and economic development, but also for societal destruction. And I don't mean destruction of people like a bomb. I mean destruction of our current ways of doing things and us having to learn different ways to do things. So the next 10, I introduced this last month. The next 10 days as the second quarter earnings season ebbs, where are the winners? Which sectors will shine? Does the technology sector still have to carry the ball in this secular bull market move, or will technology share the love with the other 10 sectors? For the record, I said earlier, the communications sector is actually the number 1 sector. Technology is 2. Communications sector and technology and consumer discretionary are the 3 most aggressive sectors. They are our favorites. That's predominantly what you'll see in the CG Capital Growth Investment Program, those of you that are clients. All right? So who will or won't appear at the first Republican debate? That may seem like a flippant question, but honestly, it's going to be something that will affect the tone of the race in 2024. Will Donald Trump just basically stay out until he absolutely has to come in and debate? We'll see how that plays out. In the next 10 weeks, can the market hang tough enough to make it to the fourth quarter with little or no significant pullback? Remember that I said earlier, August and September, the doldrum months. July, August, September are the doldrum months, I suppose. Certainly, it's possible that we could have a significant pullback. We'll wait and see. I don't think it's going to happen. When I say significant, I mean 5% or more. And can the U.S. hit a new lifetime high before 2024? So in the next 10 months, I'm following the story that India is drawing closer to the U.S. After decades of being heavily dependent on Moscow for military hardware, New Delhi is no longer sure it can count on Russia. Will our partnership deepen with India? That is something I would be very interested in. India, if not today, within a year or so, will be the largest population on the planet. They are a pseudo-democracy. They at least purport to be a democracy. We want them to be on our side and not buying hardware from Russia and certainly not buying hardware from China. So I'm hopeful that would happen, and that is something that's really important for the next 10 months. All right. Will China and Russia continue to test the U.S. military resolve to patrol our borders? Now, I said earlier, you guys know these balloons that were going up. We're being taunted. Now, again, you can say that's because, maybe they perceive we have a weak president. I'm not going to jump out on that, okay? Because, again, I don't care about politics. I care about policy. And I don't know why Putin and Xi are doing what they're doing, but we are seeing provocateurs that are encroaching on the U.S. And it's kind of like there's a little bit of bullying on the playground here. It's one thing to send an air balloon. It's another thing to send 11 battleships right off the Aleutian Islands, okay? It's not like they're off the coast of San Francisco, but still, it's concerning. So I'm watching that over the next 10 months as we head into the 2024 election. Will one or will both leading candidates be convicted of felonies or even imprisoned? That would be a first in history. And the next 10 years, I showed this slide last time. I'll probably show it for a little while here because these are the trillion-dollar cities. So in the next 10 years, these are 10, I guess technically number 9 and 10 aren't quite a trillion, but we'll know by 2035 if they end up being trillion-dollar producers. I'm pleased to see that even with the exodus from Illinois, Chicago is still listed at number 8 at being a $1.0 trillion city. There will be no other country in the world that has as many trillion-dollar producers as we have. Now, you can see China is going to have 4, but I think when it gets there, you're going to see both Philadelphia, Dallas, probably Miami. It'll be interesting to follow this. That's why I'm looking at things the next 10 days, weeks, months, and years. And finally, our methodology here. We have the segment at every ending of the show here because I want you guys to know how we do things and why we do things. So this is a new thought that I want to share with you. Unidentified problems are the worst. Identified problems without planned solutions are better, but worse for morale. Identified problems with a good planned solution are still better, and solved problems obviously are best. Now, you would think that makes sense, but when you're breaking down a challenge you're facing in the markets as a portfolio manager, what stage is that problem? Is it newly discovered? Does it, at least if we identified it but we don't have the solution, have we identified the problem and we are working on the solution? And then finally, do we have it solved? And that can take anywhere from a day, depending on if it's a trading order issue, to years, okay? But it's really important to know to which investing category a problem belongs. The metrics you use to track the progress of your solution should be so clear and intuitive that they are obvious extensions of the plan. I know that's wordy, but if you're watching this, go back, take a screenshot. I'm going to go back to it. This is our mindset and how we start our decision-making process when we are trying to continue to improve our investing methodologies for you. Many firms charge you for financial planning. They're called wealth managers. We are not wealth managers. Yes, we do have a wealth planning module on our site and we can help you there. But if you have really, really in-depth wealth planning needs, you need to go to a specialist, and we have 3 that we recommend. We are portfolio managers. We believe if you're paying us a fee every single day, we need to justify that fee by letting you know how and why and when and where we're making decisions. More on that at the September Fireside Chat. You'll want to be there for that, okay? Or watch it on the line here. So central to our problem-solving task is to discard the trivial noise moves and identify the much more important moves. So since the noise in the market, and there's tons of noise, we had a lot of it today. Big move up, big move back down, just traders playing with the market, okay? The foundations of our method must be to find the strongest trends, avoiding the noise, and then hold those assets as long as possible until they fade. And what I mean by fade is until they basically fail. All right, we had to sell Apple this week. I haven't sold Apple in a long time, but it fell below our threshold. It wasn't an emotional decision, it just fell. I've been waiting for an opportunity to add Amazon. I sold Apple. I bought Amazon within about 5 minutes and continued on without blinking. There was no emotional loss. There was no breakup. There was no Dear John letter from Apple to me or me to Apple. It's very unemotional. Okay. I date my stocks. I married my wife. All right. I think that's a pretty good description and a pretty good choice. So this is one of our most recent tools. And we have somebody say, you really got complicated stuff. Can you spend a little more time on this? So I'm just going to go through this a little bit. This is an analysis of Adobe. See, the upper left-hand corner says toggle. So this is the leading artificial intelligence company out there. And what it does is aggregates thousands and thousands, arguably hundreds of thousands of scenarios. So I'm looking at various conditions for Adobe. Look down there and you can see I've ticked the box, a 6-month price rally. Okay, what are the market conditions? So below that, you can see the S&P drops 2% in a day. The Nikkei drops 2% in a day. Dollar weakens 5% in 1 month. All of these secondary conditions. And then I can project them as to what has happened in the past. So look at the result of past episodes. There's a whole list of them. Now, what I like when I see this is the number of probable outcomes. 505, you see the number in green, versus negative outcomes. All right, so the risk result summary, look down from there, 6-month horizon. The best case is 161%. The worst case is 59%. I mean, you guys don't have to be a math whiz to know that the probabilities of succeeding in Adobe in the current environment based on historical events, again, using artificial intelligence to project, if this same scenario, which has already happened, were to happen again now, the chances are much stronger that you want to be in Adobe and not out of Adobe, all right, not flat. Here's another example. And the reason I'm showing you this is Elf Beauty. This has been an enormous winner for us. And it's been tough to hold. A lot of people will say to us, sorry, I'm going back and forth between on camera and off camera, but I just need to look at you when I say this. People will say, do you ever just sell when it gets to the top? Okay, well, yeah, where's the top? Well, the last high price. Okay, but how do you know that? You don't know that. Well, if it's really, really high, you should sell it. What's really, really high? I mean, $2 stock goes to 4,000. Has that happened? Look at Amazon. Okay. So we don't want to sell anything too early. All right. But what we can do on a stock like ELF is say, okay, so what about low trading volume? See the little yellow tick there? It says low trading volume. We're going to use that as a condition. And then we're going to use the secondary condition of the S&P dropping 2% in a day. Follow your eye down. See the little yellow check mark. And then I'm going to run all the scenarios there. Okay. Now look under the risk reward summary. All right. Just like we did last time. Best case, 130% move. And the worst case, a minus 36. All right. It doesn't take a mathematician to know that the possibilities of staying in the stock for a long-term appreciation are not only better than average, they're better than most stocks based on the history of how ELF, which I discovered, well, I didn't discover, but my wife puts my makeup on every show, and she said, here's ELF, here's ELF. But the point is that these are the kind of tools that we have available to us that I needed a staff of 10 people 10 or 12 years ago. And yet I work with a team of people now, small team of people, that does this kind of analysis on your behalf so that we can make the best decisions possible to know when to not only not buy a stock, to buy a stock, and how long to hold it. All right. Hope that helps. So this is where we are. We're almost at a 12-year track record. This is a actual audited, my account at Interactive Brokers. My benchmark account in CG, you can see we have pretty much tracked the S&P until I decided to, with that downturn in 2020, it's like, I really got to get on the ball here and hone my stock buying chops. And you can see the blue line and how we did for the next year. Really, really good. There's a problem when you see the rest of the chart. What I was not honing was my risk management strategies. Now, we've always had them, all right, but when you have that kind of an appreciation, it takes a different type of risk management strategy on the downside. And you can see that we've now been trailing the S&P for about 10 months. However, let me zoom into this year and look as we've applied the recent techniques. Now, those of you that are listening for the first time or haven't seen the show, I've been talking about this strategy that I've worked on with that hedge fund trader, Tom Basso. I don't want to go into it right now, but basically I've been tutored by a multi-gazillion-dollar trader who took a liking to me because I did a good interview with him, and he's just helped me with how to manage, basically he's managed $1 billion in today's money before he left the business and retired in his 50s, low 50s. So maybe he was even in his 40s. But the point being that I've learned a ton, and that's how we've made up this ground and how we're going to continue to do so with this track record. All right. Another thing that I'm able to do with technology that did not exist even 3 or 4 years ago is track every single trade and how it's performing. So again, I know there's a ton of data, but it's important that you see this. So look at the return percentage. So drop your eye down that first column. You see return percentage 33%. You might think that's not very good. Well, in our industry, you're looking for a few great stocks to be monster hits like Elf, like Adobe. So if you can get a winning percentage anywhere from 35 to 36%, when I started tracking this, I was at 26%. All right, we've risen to 33. Now, move your eye over to the third column where it says profit and loss ratio, 2.3 to 1. That means every winning trade has a 2.3 better return than a losing trade, all right? You want to see that get to about 3.3, and then you're in great shape. So these techniques are what I'm working on because it's our money. As you guys know, and if you're new to the show, if you don't know, I trade our family money here at CB3 Financial, and all of our clients trade what we trade. They may not trade in the same mix. They may have less risk tolerance or not have as much aggressive desire as Alice and I do. But the reality is I know what's in every single portfolio because I'm trading it, buying and selling everybody's stocks on a trading block at the same time. It's different than someone else farming out the investing for you. And that's the what question. What's in your portfolio and who's managing it? More on that in September. You'll want to watch that show. All right. So at this point in time, I believe that all our clients' objectives can be handled in 2 programs, CG and GI. CG is approaching a 12-year track record, I just mentioned that, of strong growth with a more defensive attributes than the unhedged S&P 500. What that means is we're keeping up with the S&P close, all right, but we have risk parameters in place now that were not necessarily in place in 2022, but they certainly are now. Okay, the S&P can go from having a great year to being down 56%. I don't see that happening to us again because of the risk parameters that we've installed based on this extensive tutoring that I've had with my good friend Tom Basso. And GI is going to take a different approach. Okay, it's evolving into an all-weather program. So that means it's going to trade more kinds of assets, currencies, bonds, commodities, etc., that tend to reduce volatility. So assets other than equities tend to do better when equities are not. Money doesn't just evaporate and everything does badly. Okay, money moves to other sectors of the economy, other spaces, other asset classes of the economy. And that's what we're going to be doing in GI. So this collection of assets is not going to ever outperform. Well, not ever is a big word. It's hardly likely that it's ever going to outperform a CG, where CG is up 20% this year. Those of you that were with me in 2020 know that we were up 63%. An all-weather program like a GI is not going to do that. But what it will do is it will offer a psychological and financial cushion during stock market weakness. So except for the very most risk-averse clients, CG should be in the mix of everyone's investment portfolio. That's with me. Except for the very most risk-tolerant clients, GI should be in the mix of everyone's investment portfolio. Now, I have some multi-million client that are traders themselves, and they're only going to be in CG because they like the style that I have there, and they don't need GI because they have a bunch of other diversification. But between these two programs, that's where we're headed. We're making changes right now, and GI is going to be fully implemented, if not by the fourth quarter, by the first quarter. So that is why I will schedule review meetings with every CB3 client this autumn to review their objectives and to encourage participation in both CG and the newly more robust GI. This is a quote that I showed last time. I really like it. So 85% of my net worth is in my own funds. Why? Because I primarily believe it's the safest place in the world for it to be. I believe I'm going to be so defensive and so conservative that I'm going to get my money back with an acceptable return. Note that it doesn't say outstanding return, it says acceptable. And that's because people like Paul Tudor Jones and Tom Basso and many, many other very successful hedge fund traders focus on risk management, not finding the latest, greatest stock. That's all good, but those will happen. How do you protect the downside? That is the hyper focus going forward. That's why I say ditto. Worth much, much less than $7 billion, but I have the same mindset. Risk control is now and will always be the absolute essence of my trading methodology for as long as I'm doing that. And as I said last time, the reason I have a segment called The Next 10 is because I announced to you guys, and I'm reiterating here, and I'll say it again in September, I plan to do this at least 10 more years. So I would be 78 in 10 years. That is still 15 years younger than Warren Buffett is today, and he has more money under management than I probably will ever have. That's a safe assumption, all right? That's my commitment. I love what I'm doing. The challenges are unique and exciting every single day, and I will be here with you guys. That is our show. These are our segments. Go back and review any of them that you find interesting. Send me questions if you have them. Our next program, Thursday, September 21st. Be sure you notice that is the third Thursday. Why? We need an extra week to get ready because it's a live show. The chats are back. Thursday, September 21st at the Batavia Library. Those of you that are coming in from out of town, we're happy to make hotel reservations. Obviously, you can still watch it online, but it'll be fun after 3.5 years to actually show up. Here's some pictures from 2020, 2019, 2008. It's going to be a really great time. So retirement should be your second life, folks, not your waiting room for death. I've been saying this for many months now. And I always end the show with this. For we have not been given a spirit of fear, but a spirit of power, love, and of a sound mind. 2 Timothy 1:7. We need to be optimistic. I told you earlier in the program. By the way, if you've got questions, we're on a 25-second delay, so type them in now, okay? I've run a little bit long. I appreciate you guys hanging with me, but I thought it was important. I hope your summer's gone well. We've had a good one here. We are thrilled to be back in Chicago with our grandchildren and our children. Can't really have grandchildren without children, right? So we love them, all of them. We have 3 sons and 3 grandchildren here, 2 granddaughters and 1 grandson. And then we have on the East Coast a bunch more. So, but we are here. It's glad to be back where I can get to you guys. I can get to my clients. I can meet with you. I can hang out. We can talk about things. It's never been a more exciting time to invest in America, and I am just thrilled to be embarking on the next 10 years of that with you. When you come to the chat, we will be doing a simulcast, so it's a fireside chat with a live audience, but the cameras will be there. We'll be transmitting live on YouTube, so I'll have to split my time looking at the camera like I'm doing now and then addressing the people there. We're not quite sure how it's going to work out. We're sure it's going to be fun. But hope you guys will be there. Thanks, Debbie. I appreciate your comments. Thank you. Hossein, thank you. I hope you're feeling better. I know, Hossein, you had kind of a little medical thing going on there, but hoping that's working out. Guys, we care about you. You mean a lot to us. Can't tell you enough how honored I am to be able to talk to you guys every month. Please send questions. I hope I answered this question that I got sent. It took me about a month to get to it. But send me your questions, cb3@cb3.com. We're always here for you. God bless. Remember that at CB3 Financial, we don't just manage your assets, we become one of them. We do. We will see you in September.